So what is driving the price up? Obama says it's Iraq. Of course, what else could it be? Well, but Robert J. Samuelson of the Washington Post says he has a better explanation. He says it's basic supply and demand. Despite the U.S. slowdown, the world economy has boomed. Since 2002, annual growth has averaged 4.6%, the highest sustained rate since the 1960s, according to Michael Musa of the Peterson Institute. Interesting. So does Obama really understand the basics of supply and demand? We're not sure. Take 2 of these and call us in 2012. But what about speculators? Here he's onto something. Could it be the speculators, which he says are the culprits in the volatility that has caused oil prices to rise to nearly $140 a barrel in 18 months? It's this guy. At least I'm pretty sure this guy did it. But come on. I mean, this guy just works here. He's trying to make a living, right? Because this is what speculation is. Obama would like you to believe it's a bunch of greedy, money-hungry guys like this guy trying to make a fast buck. But that's not what speculation is. What speculation is betting on the future price of oil. Except it's not betting. It's more like insurance. So, if you're in the airline industry, the transportation industry, the shipping industry, and you use a lot of fuel, you're looking at today's oil prices and you're saying, boy, this is killing us. But if oil doubles again, we are out of business. There is no way we can make money. So, what are we going to do? Well, you've got to hedge. You've got to buy insurance. And how do you do that? You buy energy futures. Which means that if you buy futures, it means in the future you are purchasing energy at today's prices. You're locking in today's prices. So that means if the price continues to rise, you'll be able to buy at today's prices. However, if it goes down, you've actually lost some money. But hey, it's like life insurance. If you don't use it, all that money you paid is kind of worthless. But hey, at least you're alive, right? Well, and this is how companies think about this. So when Obama's talking about speculators, he's not completely wrong. But it's not that they should be forbidden or outlawed or overregulated, because that's what companies are doing to stay in business. And the eminent Robert J. Samuelson has a different culprit. He says that politicians share part of the blame. But he says, in general, the futures markets aren't the main problem. Scarcity is. Supply and demand coming back again. Government subsidies for corn-based ethanol have increased food prices by diverting more grain into biofuels. And a third of this year's U.S. corn crop could go to ethanol.
Alcohol, man.
And restrictions on oil drilling in the United States have limited global production and put upward pressure on prices. This is Robert J. Samuelson of the Washington Post. We're not talking about some right-wing blogger here. So what he says is, if politicians wish to point the fingers of blame, they got plenty of places to point it, and they should start with themselves. Touché, Robert. And the reality is, folks, that speculators alone cannot cause prices to increase without any fundamental reason. The fact of the matter is that a lot of companies who use oil are afraid that prices will continue to rise. And they're buying insurance against that. And why are they afraid prices will continue to rise? That is your main cause, and the reason why they are afraid is because they, like the rest of us, see global demand increasing faster than global supply. And so, when they do buy insurance through the futures market, that can cause prices to accelerate faster than they otherwise would have, and we're going to talk about that in a moment. So, but if it's not speculators that are the fundamental cause, then what? Well, Robert J. Samuelson had an interesting thought. It could be the Wonder Twins. We're talking about India and China here. These two economies have been exploding in the form of declining global poverty. That scourge. Come on, guys. We're happy that you're doing well. Just stop buying our oil. Ah, but darn it, this is not as marketable. Are you sure we can't pin this on Halliburton? They've got to be involved in this somehow. India, China, declining global poverty? Whew, that's not sexy. All right, but Greenspan and every other economist seems to get it. Just a few days ago, in an interview with CNBC, Alan Greenspan said there are long-term structural problems in the oil market. Consumption is running far in excess of the rate of capacity because we're not investing enough to take the oil out of the ground to balance the demand that's coming mainly from Asia. India and China again. There has been this pressure on the notional value of basically crude oil futures. We are moving forward a price increase which was going to happen anyway. So the reality is, and he agrees, this is indeed speculation, but it's not the cause. It's causing prices to move forward more quickly than they would have. So the reality is, we were headed for this price increase whether we wanted it or not. Speculation is just causing it to occur sooner. And more to the point, prices are high today because companies who hedge against future price increases believe that there will not be enough supply in the future. Alan Greenspan, so wise.
When 900 years old you reach, look as good you will not.
This is not something that is going to give consumers short-term relief. He's talking about drilling here. And it's not a long-term solution to our problems with fossil fuels generally and oil in particular. But so, this raises an interesting question. What if those same speculators who are betting on the future believe that in the future that there may be more supply due to new sources to meet that demand? It's simple. If you believe speculation is accelerating prices, and Obama does, he said that. If they're accelerating prices today based on future expectations, then you change future expectations. What does that mean? You drill now to send a message to the markets that there is going to be more oil in the future coming out of the ground than we have today to meet that demand that everybody knows is going to be higher in the future as well. And so if you're still not a believer, this is the price of oil over the last 5 weeks. On July 14th, Bush lifted the executive ban on offshore oil drilling right at the peak of the market. And look what happened. Oil fell dramatically, over $20 a barrel, and it fell again the day that Obama said that maybe we might drill if we do this and if we do that, and I don't really want to. And oil fell further when it became obvious that the Democrats were under pressure and that they were going to have to do something. So global oil fell 20% in 3 weeks, mostly on the belief, just the belief. No oil was coming out of the ground, no extra oil. But it went down mostly on just the belief that the U.S. is getting serious about oil exploration. Perception becomes reality in these markets.